This is Al Brooks, and this is my price action trading course. This module has to do with taking profits. You need a plan to manage a winning trade, and you need to protect your profits as you let them grow. You also have to take profits before they disappear. The tools that you use, first of all, you begin with a protective stop. Next, you trail the stop as the market goes your way, and you can also use break-even stops. You want to take profits before they disappear. You need goals when you entered the trade originally, and you adjust your goals once you see the strength of the move. When you enter a trade, if the goals are really not all that clear, rely on defaults. For example, you'll put an initial risk beyond the signal bar. For example, if you're buying, you put your stop below the signal bar, one tick below, and you take partial or full profits at twice your initial risk. And if you took partial profits, you swing the balance. In terms of scaling out, if you are trading a big enough position that would allow you to scale out, you might take half off once the profit reaches twice your initial risk. Take another 25% off at 3 times your initial risk, and then swing the balance and trail the protective stop and look to exit before the end of the day if it's a day trade. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. As an example, let's say you buy 400 shares of the SPDR, the SPY, which is an ETF, and you bought them at 140 even. If the signal bar is 22 ticks tall, then you're buying 400 shares on a stop at 1 tick above the high of the signal bar. Your initial protective stop is 1 tick below the signal bar. So your total risk is 24 cents. The signal bar 22 cents tall, you buy 1 cent above, your stop 1 cent below. So a risk of 24 cents, and you have 400 shares, so your total risk is $96. Although this example is based upon the SPDR, the SPY, this example is to illustrate trading principles, and I actually modified the prices slightly to be able to use round numbers. But the prices that I am citing in this example are very close to those of the actual day. Here's an example. You have a gap down with a very strong bull signal bar. The signal bar is 22 cents tall. If you're buying on a stop, you're buying at 1 tick above, and your stop is 1 tick below. So your total risk is 24 cents, 24 ticks. You set up your initial targets based upon your initial risk. Your initial risk is 24 cents. 2 times your risk is 48 cents, so you take half off at 2 times your risk. 3 times your risk is 72 cents, so you take another 25% of your trade off here, in other words 100 shares, and then you would allow the final 100 shares to continue in the market as long as the trend continues, relying on trailing stops below the most recent higher low, and you try to exit right before the close. After you enter, if you see the market pull back like this, that is not a strong sell signal bar, so you rely on your initial stop and hope for the best. Here you can see a big tail on the bottom of this bar, and that's caused by bulls aggressively buying, trying to prevent the market from coming down, hitting their stop, so the bulls are adding on. As the market starts to go up, as this bar is forming, as this big bar is forming, you quickly determine what your actual risk was. Where did you have to have your stop to not get stopped out of the trade? Well, if you bought here and the market started to turn up here, you would not have been stopped out if you had your stop one tick below the low of this bar. And that is 21 cents below, that's 20 cents below your entry price, which is above the high of this bar. So your actual risk is one tick below the low of that bar, and that price, that red line, is 20 cents below your entry price. So your actual risk is 20 cents. You'd quickly figure out where 2 times your actual risk is, 40 cents. So 2 times your actual risk is this blue line, this red line, and the market went one tick above it. So you would have exited half of your position, 200 shares, at 2 times your actual risk of 40 cents. And you can see that tail there indicates that a lot of traders did the same thing. So the market rallied to 140 and 40 cents. It reached the minimum target of 2 times the actual risk, or 40 cents. You take half off, 200 shares at 140.40 on a limit order, and you have so far locked in $80 profit, 40 cents times 200 shares. You have 200 shares remaining. If you get a possible sell signal, you could either exit your remaining 200 shares and look to enter again later, or you could continue to hold and rely on your protective stop. Okay, so after you took off 200 shares, you have 200 shares left. The market did not reach 3 times your actual risk, your second profit target, and instead it developed a wedge shape and a failed bull breakout. So this is a possible place to exit. I don't know about going short. I would not. I think the market's always in long. However, the stop for an always in long position, a swing trade, is below the most recent higher low. So it would be below this bar, which was where you moved your stop after the market turned up. If you do choose to exit here and the market sells off, you can always look to re-enter. This is a reasonable thing to do. It is reasonable to exit here because of the wedge shape. We may get a pullback. In fact, the bears developed a very strong breakout. So you could have exited there, or you could have held, and we have 2 legs down, 1 and 2, which is common after a wedge. But look at this bear breakout. What kind of follow-through did it get? It got a very strong bull reversal bar. So that is a failed breakout setup, a failed bear breakout setup. The market fell to below the entry price, so it would have stopped out weak bulls who moved their stop to break even too early, but it would not have hit a stop below the bottom of the bull spike. Very often when you have bull trends that don't look particularly strong, you get a very big sell-off, but it does not hit a stop below the bottom of the spike. And this was probably a sell vacuum test of the weak longs, the longs who put their stops at break even. The market quickly came down, wiped out those stops, and reversed up. Okay, so we have a wedge and 2 small legs down, and a bear breakout and a signal for a failed bear breakout. This is a pretty good looking buy signal bar, and if you understand what's happening, that this might be simply a sell vacuum to wipe out weak longs, it's a reasonable buy signal. It's also a higher low major trend reversal. We had a bear trend, a strong rally, and then a 2-legged sell-off and a strong reversal. So if a person was flat at this point, for example, if they exited up here, this would be a good place for them to re-enter for a swing long. Some traders, if they took half off up here, they might put their second half back on. So for example, some traders might buy at 1 tick above the high of this buy signal bar. In the example that I'm giving, I'm going to rely on the original entry back here and not discuss a second entry over here. If the bull resumes, okay, if we start to rally again, at that point I personally would move my stop to break even. I don't want the market to hit the break even stop once, rally strongly, and then come back and hit my break-even stop a second time. That's not the way I want the market to behave if I'm looking for a swing long. And every time the market tests the high or goes to a new high, I'll trail the stop up to below the most recent higher low. So for example, when the market runs up here and tests the high, I would move my stop to below this low. When the market comes up here again and tests the high, or maybe up here after it actually goes to a new high, I would trail the stop up to below this most recent higher low. If this is a bull trend, I want it to keep forming higher lows. Right now it is a bull trend. It's forming higher lows, not quite forming higher highs. We finally got one here, but it's also a trading range. So at the moment we don't know if this is going to remain as a trading range or if we're going to continue up in a bull trend. We're just below the target for the second exit, and we're getting a bear reversal bar. So that is a problem. Traders will probably look to exit below this bar, especially since it could be a failed breakout above the top of a trading range. This pink box shows that we're in a trading range. We've been sideways for hours. And I think most bulls would exit below this bear bar. So if the market falls below this bear bar, the bulls will just exit. Bears might short because it's the top of a trading range. The rally up is not all that strong. We've had selling pressure on the way up, and it is a reasonable short. Personally, I don't like to reverse except under exceptional circumstances. So most of the time, if I'm long, let's say I bought here, or if I bought here, or if I bought here, or even here, I would exit my longs below here because this is a reversal down at the top of a trading range. We have pretty good selling pressure throughout the trading range, and we have a bear signal bar. A small body, so it's not a particularly strong signal bar, but it is enough for me to exit a long. If I were flat, I would consider going short, but I don't like to reverse because it's too much to process. I'm trying to think about the bull case and to also think about the bear case and to make the trade and do it correctly, place the orders correctly, all within a very short time, is something that I don't reliably do. So I'd rather, if I'm thinking about getting short, I'll get out of my long over below this bar and then wait a few bars to see if there's another sell signal and then take the second signal. Okay, over here, the market did not trade below the low of this bear signal bar. The market had a little inside bar here, and instead of going below it and below the bear bar, it found buyers right at the low of the bear reversal bar. So that's a sign of strength by the bulls. They prevented the bears from triggering a short and from running the stops. A lot of bulls would have gotten out below this bar, but the market did not get there, so that's a sign of strength. The market went a tick or so above the 3 times the actual risk, so bulls can take off another 25% of their position, 100 shares, at 60 cents profit, and then trail stops below the most recent higher low. So you take another 25% or 100 shares off at 140.60 for 60 cents profit, which is $60. 60 cents times 100 shares, 6,000 pennies, that's $60 profit. Okay, this is the last bar of the day, and we're still rallying, and most bulls would get out right before the close. They might get out here on this weak bear close after a possible exhaustion, but let's say you exited right before the close. You would have exited with 85 cents profit on your remaining 100 shares. You would hold those 100 shares until the market was no longer always in long, or until there was a sell signal, or until the market hit your trailing protective stop, or until moments before the close of the day, which is what we did in this particular case. So when you took your final profits on that remaining 100 shares, you made $85 on that final 100 shares. Your total profit is $225. Your initial risk is $80. Remember, you had a 20-cent stop and 400 shares. So on your first 50%, your first 200 shares, You made $80. You exited at 140.40. You took another 100 off at 140.60 for another $60. And you took your final 100 off at 140.85 for $85, giving you a total profit of $225 on your 400 share trade. Well, let's say you were a little richer and had a bigger account. So instead of trading 400 shares, you traded 4,000 shares. The spider can easily handle 4,000 shares. And in that case, everything would be tenfold greater, and your final profit would have been $2,225, and your risk would have been $800 instead of $80. Well, let's say you were trading even bigger. Let's say you're a fund manager, and you were trading 400 E-mini futures contracts instead of 400 spider contracts. Then everything would be substantially larger, and your final profit would have been over $100,000, and your initial risk would have been $40,000. And the E-mini futures market, the futures market can handle 400 shares. That is not an unusually big trade for the E-mini futures contract. Sometimes when you're in a position, a swing, your profits grow very large, very fast. You always have to keep your dollars at risk below your maximum. You have to reduce your position size based upon your current stop. You keep trailing the stop up, but as the market gets further and further from your stop, let's say in a bull trend, the market keeps rallying, your risk is greater. Every now and then you'll hear someone say, "Oh, it's okay, I'm trading somebody else's money." You're not trading somebody else's money. You're trading your money. Once it's in your account, it's yours. And trade it like it's yours, and keep your risk, your maximum risk, the same. Don't increase your risk. So for example, let's say your normal risk is 20 cents in the spider, and you normally trade 500 shares. So your total risk, maximum risk, is 1,000 ticks. Do not risk more if the profit grows. For example, if the market rallies and you're long, and your trailing stop is now 40 cents away, that means you're risking 2,000 ticks instead of 1,000 ticks. Take half off to get your risk back down to 1,000. You can always put your full position back on, the other half back on, during the next signal. But at the moment, your risk is 2,000 ticks, and your maximum risk is 1,000, so you have to take half off. Here's an example of what I mean. So if you buy here, and the market starts to get very far above your trailing stop, take half off. You could say, well, Al, this is another buy signal, a very strong breakout. This is another buy signal. That's fine. I would still rather take some off because when you have a profit and your risk is getting big, it's always better to take some off because you don't want to take a chance of giving it all back. So let's say at the close of this bar, your stop is here, and let's say that comes out to a risk of 1,500 cents, 1,500 ticks, and your normal maximum is 500. I would take 100 or 200 shares off. And let's say the market gets up here and you trail your stop here. Okay, you're still risking about 1,000 ticks. You can stay the same. Let's say over here the market starts getting very far above your stop, and your risk is up there at 2,000 ticks, and your maximum risk is normally 1,000. You got to take some off. If you take some off in here, you can just put it back on the next signal and then start the process over again. So if you buy above this bar, your stop is now here. So just make sure that whatever position you have, you're not risking more than your 1,000 ticks. But the important thing is, whenever the market starts getting very far above your trailing stop, your actual dollars at risk are increased. It is your money. It's not open profits. That is money in your account. So manage your trade as if it's your money, and calculate. Always be aware of how much money you're actually risking. A lot of times when the market's going up like this, and the market's over here, the trader thinks his stop is down here, but he's really not risking that. Let's say he keeps his full position on, he'll get out long before this. So he thinks this is his stop, but it really is not. It'll be somewhere up in here. So a lot of times, if he keeps his full position on, that's okay, as long as he's honest with himself and he's not actually using a stop way down here. If he's extremely disciplined and he truly is going to rely on the stop, he has to reduce his position size. On the other hand, the market's moving quickly, he's long, and he wants to take a chance. That means even though he might tell himself his stop is here, it's really not. He'll probably get out here if he has his full position size on. If he reduces his position size, he might get out down here. Key point is just keep the total dollars of risk within your comfort zone, and if your open profits are growing very big, either reduce your stop or reduce your position size, because you don't want to go beyond what you normally risk. Let's say you're talking about a possible very big trend. You have to adjust your goals. You have to you can use a default protective stop and a default position size, but don't use your default targets. You have to adjust your targets if you're looking for a really big trend. If that's the case, if you have an average size signal bar, so you have an average size stop, but you think the profit may be very large, but you're not sure what the profit target should be, don't place the profit taking limit order when entering the trade, or place the order very far above your entry price if it's a bull trade. If it's a bear trade, put it very far below the entry trade. You want to wait to see if the move is as strong as you think it will be, and if it's not, then use your default profit taking at 2 times the risk. Let the market dictate where you should take partial profits. Instead of trying to take partial profits at 2 times the initial risk, if this looks like a potentially very big move, you could take half off at 2 times your risk and swing the balance. But if it looks like it's going to be a very big move, you can move your profit target for your first half to substantially bigger, and rely on the price action to dictate where you should take profits. Okay, look at Baidu. This is a huge sell-off, a very strong sell-off over the past day or so. We have a very strong bear spike, 3 strong bear bodies, 5 of the first 6 bodies over here in this spike were bear bodies. And we have a wedge pullback to the moving average with a very strong signal bar at the moving average. You could bet on a potentially very large move. Your initial stop would be above the high of the signal bar. You'd enter 1 tick below the low of the signal bar. You could, if you wanted to, take half off at 2 times your risk, or you could wait to see just what happens here and then place a profit-taking limit order. 2 times the risk looks like it'll be above the bottom of the bear spike, and we could get a leg 1 equals leg 2 move down. So if you wanted to, you could take a chance and not put a profit-taking limit order in this area at 2 times your initial risk. Instead, put it down here or off the screen and wait to see how the market behaves. And if it's not falling too quickly move it up to 2 times your risk. If it's collapsing, you keep it down here and even drag it down further. Okay, so if you're going to use your defaults, your initial risk at 1 tick above the high of the signal bar. If the signal bar is 30 ticks tall, your risk is 32 cents. You entered 1 tick below, your stop is 1 tick above. Okay, you took the short, and you have a very strong pullback, possibly a failed breakout, possibly a higher low major trend reversal. We have a bear trend, a pretty good move up, about 10 bars, and the bears tried to break the market out, and instead it might be forming a higher low major trend reversal. Could you buy this? If I were short, I would not be thinking about going long. I would be relying on my initial stop for my swing, and I would be holding short. Now at this point, what do? If you are already short, you don't do anything. If you bought above this bar, this would be a big problem for you. You have a bull breakout, but immediately a failed breakout possibility on the very next bar. So the bulls would probably get out below that bar. Traders who are totally flat, they see this as a double top bear flag with a very strong signal bar at the moving average. They would go short at 1 tick below the low of this bar. If you're already short, you might add to your position if you feel particularly aggressive. Still not much going on. Not a strong entry bar, not strong follow through. Okay? If you were going for an initial target of 2 times your initial risk, that would be 64 cents down here. You could also adjust it based on your actual risk, but it's not much different. Your actual risk, once this bar formed, you would assume your actual risk was to 1 tick above the high of this bar. It's just about the same as your initial risk. You could switch over and exit at 2 times actual risk. You could keep it at 2 times initial risk, or you could take a chance that you'll get a very strong leg 1 equals leg 2 move down and not exit until you see more of the move. Alright, if you did not exit half at 2 times your initial risk and you saw this huge bear breakout bar after this bear bar, after the double top bear flag, you would be thinking that there's a chance we could get a leg 1 equals leg 2 move. And if you saw this, you could take some off here, maybe take off 25% instead of 50%, or you could keep dragging your profit-taking limit order further down to see if we quickly get a leg 1 equals leg 2 move down. Regardless of what you're doing with your profit-taking limit order, we have a very strong bear spike. I would lower my protective stop to above the top of the spike, maybe even to above the top of this very big bear bar. Okay? When the probability of the move is high, here we're in a very strong bear trend, so we're probably going to fall further. So your probability is high. You're pretty confident, 60% or more. You can take some off or all off at only 1 times your risk. The trader's equation is positive when the reward is equal to the risk when you're confident of the move. Here you look at that chart and you say, yeah, it's falling. I'm confident it's going to fall more. When that's the case, the probability is high. You can go for a reward that's equal to your risk instead of twice as big as your risk. So what is your risk? I usually use the open of the spike to the close of the spike. So at the moment, this pink bar is what I would use for the measured move target. So the open of the first bar to the close of the second bar, it's $2.03, and this would be my target. So at this point, I would be pretty confident, 60% confident, that the market's going to fall to this point. So if I were still short my full position, I would take half off once the market got here. So at this point, I would place a limit order to take half off at this point. You could take a chance that it's going to collapse, but to me, I think it's a pretty reasonable target to take half off here and see how the market behaves if it gets there. Okay, what happened? Okay, no pullback. The spike is growing. So at this point, the spike is now this big. Instead of this big or this big, it's all the way down to here. As the spike is growing, I'm going to keep lowering my profit target based on the height of the growing spike. So with the close of each bar, my pink box gets bigger and my profit target gets bigger. So I keep adjusting my profit target as the spike grows. Traders will continue to sell closes. They'll sell this close, they'll sell that close, they'll sell this close, they'll sell this close, but they'll make sure that they don't exceed their comfort zone for their maximum dollars at risk. You don't have to sell every close. You could sell 1, you could sell 2, you could sell 3. It doesn't matter. The market has a high probability of going down equal to a measured move based on the height of this spike from the open of the first bar to the close of the final bar. Okay, the market's pausing in here. So at this point, the initial spike has ended. So this would be my target for taking profits, either full profits or partial profits. Now that the market's resuming down again with a pretty big bear bar closing on its low, I would lower my protective stop to above the high of this pullback. Okay, the market is still falling. Another strong bear bar, a big bear bar closing near its low. I would feel comfortable trailing my stop to 1 tick above its high, especially since at this point I have a large open profit. If I were flat, I would be selling closes. I'd sell that close, I'd sell this close, and I would keep selling closes until there's some sign of a bottom. Okay, now what happened? We fell below the measured move target. We had a bear spike, a pause, and then we hit the measured move target, and we hit it in a very big way. The bear bars are getting bigger, closing on the low tick. To me, I would exit my total position. This is a series of consecutive sell climaxes. We sold off here, we sold off very strongly here, and even stronger here, and the very best bear bar of the entire trend is occurring right at resistance level, right at a support level, right at my measured move target. So for me, I would go totally short here, knowing that the market may go down a little bit further, but I would take full profits. In this case, it would be $8.35 in Baidu. But we're at a support area, a measured move, and we're having consecutive sell climaxes. So we might reverse here, or we might reverse soon. And this is what happened. We had two more little pushes down, and a little wedge bottom, 3 pushes, 1, 2, 3, and a bull inside bar, a tail on top, so not great, but the context is good. After a series of consecutive sell climaxes, and now we have a little wedge bottom at support, a double bottom at support, or triple bottom at support. Remember, support was here, the measured move. To me, I personally would go long here, and I would look for at least 10 bars, 2 legs up to at least the measured move, maybe to the top of the bear spike. And had I bought here, I would be holding long and looking for at least 10 bars and 2 legs up. Okay, we're going into the close. We're getting a 2-bar reversal. We're getting a series of bear bars. I would exit my long at this point. Where would my stop be had I bought here? In fact, I did buy here on that particular day, and I did sell up here. But had I bought here, my initial stop, probably I would have put it below the low of the signal bar. I might have used a wide stop, like based on the height of this spike. I might have put a stop, a measured move down. But given this particular setup, I personally just put my stop below the low of the signal bar and took my chances. Initial risk versus actual risk. The initial risk is the number of ticks to your protective stop, your original protective stop. The actual risk, I've talked about this many times, it's the number of ticks plus 1 that the market moved against you before resuming towards your target. So for example, if I bought and then the market rallied and then it came down but did not hit my stop and it rallied up again, had I had a stop in the market that was 1 tick below that higher low, I would not have been stopped out. That is my actual risk, and I can adjust my profit targets based upon the actual risk. It's the number of ticks that I would have had to have to not get stopped out of the trade. It's sometimes reasonable to convert a swing trade into a scalp. Most swing trades start with low probability, but in the breakout phase, the probability of a successful trade is often 60% or higher. When the probability is high, you can exit with a reward that is equal to the risk. You don't have to go for 2 times the size of the risk. You'll still have a positive trader's equation when the probability is that high. And when that's the case, it's okay to scalp. An example, let's say you have a bull breakout late in the day, and you start to see some evidence of two-sided trading, and you're not certain that the market will go far enough your way before the end of the day, or if it'll pull back first. However, you're willing to take a chance, and you're willing to rely on a swing stop. Then you go ahead and you buy it as a swing. If the market quickly goes your way, and it reaches a reward that's at least as big as your actual risk, you can scalp out, and that's a mathematically sound thing to do. In the breakout phase, the probability is 60% of higher prices, and if you get that right away, you can scalp out. If it goes against you, either you can rely on the swing stop, or you could add on lower, and if you add on lower, you can look to exit the entire position at your first entry price, getting out break even at your first price and with a profit at your second, or you can just hold and see if you get a big move up into the close. So how do you determine the actual risk? After you enter, you count the number of ticks that the market moved against you before it started going your way, and you reduce your target to that number of ticks, and that converts the swing into a scalp, and it maintains a positive trader's equation. For example, here we have a market that is becoming clearly always in long. We have a strong bull breakout, 3 strong bull bars, and it's getting late in the day. We're in the final hour. So the swing stop for anybody buying at any point and for any reason here would be below the bottom of the spike. This is after a lower low major trend reversal. We had a bear trend and a break above the channel, a break above the trend line and above the moving average, and then a lower low major trend reversal, and now we're getting a lot of buying pressure, a lot of consecutive bull trend bars, and here we're getting large bull trend bars, so the odds are high that the market's going higher. Anyone who buys in here has to rely on a swing stop which is below the bottom of this spike. Okay, at this point, look what happened. We had the doji bar for the failed breakout attempt. The market went 1 tick below and quickly reversed up into an outside up bar. But the market went down on this bar and then up, and down on this bar and went up. So it's a micro double bottom, and a micro double bottom is a small high 2 buy. Any double bottom is a high 2. So you can buy above the high of this bar. But when you're taking that buy, if you're taking it as a swing, your stop is below the bottom of the spike. However, these dojis, and we're near the top of the day, these dojis represent two-sided trading, and it's possible that the market may not go straight up. It may go up a little and then pull back and then go up again. So if you take this buy, you're at first relying on your swing stop, and as soon as it starts to go up, you quickly calculate your actual risk. And in this particular case, the market at most went 2 ticks against your entry price. We had the entry 1 tick above this bar. The market traded 1 tick below the high of the bar, 2 ticks below your entry price. So you would have needed to have a stop 3 ticks away to be in the market as it was going up. I never go for a trade with 3 ticks profit in the E-mini, but I do sometimes go for 4 ticks. So in this particular case, late in the day, I often would quickly place a limit order to exit out 4 ticks above my entry, and I would have been filled. So I would have converted my swing trade into a scalp. Had the market instead gone down, I could have added on 1 or 2 points lower, and then wait for the market to come back to my original price, and then exit the entire position. My first entry, I'd get out break even, and on my second entry, I would get out with a profit. If I did do that, I would still be using the swing stop below. And this is what took place. So you could buy 1 tick above this bar, you'd be able to scalp out with 4 ticks, and it turned out the market went higher. So if you bought it as a swing and relied on the stop, you would have made probably about 4 points. After the market went above this high, you probably would have trailed your stop to below the most recent higher low over here. And once it went above here, your stop would be down here. You only have a couple bars left in the day, so it doesn't really matter. That's irrelevant. And you would exit in the final seconds before the close. When you're doing trades, when the market is doing this, lots of reversals, relatively big bars late in the day, you got to be very fast. Remember, you're going to be tired after trading all day, and these bars and these reversals happen very quickly. It doesn't look necessarily like they're happening quickly on the 5-minute chart, but many of these bars go up and down repeatedly as the bar is forming. So you have to do a lot of thinking, and I think it's very difficult to do. Best thing to do, you can scalp out, which is an easy way to do it, or you can just take the swing trade when the market gets up here, put the stop below this low, and keep your fingers crossed that the market will rally in a channel up for the rest of the day. We have a spike here, so chances are we're going to be in a channel. We have two-sided trading here, so the market might be entering a channel. And it turns out that it, in fact, ended up as a channel for the rest of the day. Well, what happens when the signal bar is small compared to the trend that the market is in? Do you still go for a profit target that's 2 times the size of the risk, 2 times the size of the signal bar? Not necessarily. Let's say the signal bar is 1 point tall and your default risk in the E-mini is 2 points. Instead of going for a target that's 2 times your risk, in other words 2 points, you could go for a target that's 2 times your default risk, or 4 points. Here's an example for the spider. If you normally risk 20 ticks and the actual signal bar height is 8 ticks tall, so your actual initial risk is only 10 ticks, and the market's moving in a big way, instead of going for 20 ticks, you may go for twice your normal default risk. If you normally risk 20 ticks on a trade, try to exit half at 40 ticks, twice your default risk. If you're trading another stock like IBM, for example, and you normally risk $1, you could exit half at $2. So here's an example. We have a pretty big move in the spider. The market's down about 80 or 90 cents inside of an hour or so, and we have a relatively small signal bar, about 10 cents tall. You could exit at 2 times your initial risk, which would be right here, and then move your stop to break even. Or if you wanted to, you could go to a bigger target based on the size of the trend that occurred before. In other words, don't exit, just hold and wait for a reversal, like maybe possibly exit some over here. A little parabolic wedge, 3 pushes, 1, 2, 3, after a sell climax. Around a measured move down from the high of the day to the open of the day to a measured move down. Sometimes you'll get days like this that trade up and trade down, and a lot of times they'll find support at a measured move from the open of the day to the high of the day, so somewhere down here. And those days oftentimes get back to the open, and then the bar on the daily chart ends up as a perfect doji bar. So you have to be aware of that possibility, and that might have been what the market was trying to do right here. In any case, let's say you took some off at 2 times the risk, or you took some off above this small bull reversal bar, and you let the rest go into the close. Down here, you probably would exit the final amount going into the close above this bull bar. Another parabolic sell climax, 1, 2, 3, and you have this slope, and then the slope is getting steeper, and we have a failed bear breakout below this breakout pullback, bull body, another bull body, and only a few bars left. I personally would buy back if the market went above the high of this bar and close out the remainder of my position. Okay, so let's say in this example your default stop is 20 ticks. Instead of going for 2 times the initial risk, which is 2 times the actual risk, instead of going for, in this case it would have been about 20 ticks, you could go 2 times your default risk, which is down here, and you would have exited over here. And that's the end of the module on taking profits.